You're 65 years old and you're retired with a very high income level, and high income can sometimes lead to high taxes. And so the question creeps into your mind, should I convert my savings to a Roth IRA? That's going to be the focus of our discussion today. Thanks for joining us. My name is John Vandergriff. I am one of the owners and wealth planning team lead here at Blue Ridge Wealth Planners, where we help people create plans to transition well into retirement, or if you're already retired, help you continue to progress through your retirement years, accomplishing the goals that you have. And one of those key areas that we talk about is what is going to be our focus for today, and that is tax planning. How do we make good decisions with the monies that we've put together and the taxable ramifications of that to get the most bang out of those dollars that you've saved for as long as possible. So what we're looking at is a 65-year-old who has retired with a high income. And what I mean by high income is a high income that is coming in not from their savings. Because obviously you can have a high income by just pulling a lot of money out of your 401k. But we're looking at high income as a result of good pensions, Social Securities, to a point where they actually have more income coming in than they actually need on an annual basis, which is a great problem to have. But that also sets you up with a bright, shiny red target painted on your back from the IRS, because they see a very high income, and what will soon to follow with that will be a higher tax that that person will have in perpetuity. So as we look at this, the question becomes, should they start to convert this money and get a better use of the savings dollars, since they know they're going to have this high income later? So we're going to look at this example, break this down. Obviously, we start every video talking about the fact that what we're going to talk about today is one particular situation. Do not use this alone as a way to make your tax planning decisions. Consult a tax advisor, tax planner, CPA, somebody that is going to help you make decisions, put all these things together. And again, that's what we do. But even us, we work with our clients, CPAs and tax professionals, to make sure we have all the right information. So, but as we also say, you may be learning a lot. Keep watching these videos, like, subscribe, share these with other people so that we can get the message out and get a lot of good tax information to the people that need it. So, as we said, we help people in the retirement planning. There are 5 key areas that go into what we call a plan for everything: income planning, investments, tax planning, healthcare, and family legacy. Obviously, we're going to focus on taxes and connect the bridge between income and taxes. But all these things are going to affect one another in the way that you make recommendations. So while we're only focusing on income and taxes today, that is not the only thing that matters. We need to make sure we're factoring all these things in to have a very complete and holistic plan. So again, digging into this, getting a little bit more details. Married couple, 65 and 66 years old. $100,000 a year is how much income they need to provide. But because of the jobs that they have in today's money, $90,000 of pension income, and between both of their Social Securities, $54,000 a year. So they are more than clearing that $100,000 income by about $44,000 a year, which is a great problem to have. And so they've got about $500,000 in their 401ks, but also $500,000 between either bank savings or other after-tax investment accounts. So what they're trying to evaluate here is, how do we start to get more of this money into a position where we take care of it and lessen some of the tax burden that money may have in the future? Because with this particular couple, what they have in front of them is a time where RMDs, or required minimum distributions, will start at 72. And if that happens, they're going to be forced to take out income from this 401k bucket, even though they don't need it. They already have $44,000 more income than they need, and so they'll have to take out money, pay taxes on top of a already high income. And so what we need to look at is now as a way to help hopefully get that tax paid as low as possible, because we can't do anything about the taxes owed, but we can position this inside of accounts that can give them better tax situation later. So Roth conversions, moving money out of an IRA or 401k, is a taxable event. For whatever dollars you take out, you'll have to add that on top of your taxable income. Roth IRA needs to be in place for 5 years before all distributions from the account are tax-free. If you are over 59 and a half though, and you do a Roth conversion, the principal that gets converted is available during that 5-year window. The growth would be taxable if you took out more than what you converted. So important to get that distinction, especially since we're talking about a 65 and 66-year-old couple here. They are able to access, in case of emergencies, that principal, but just try not to touch the growth because we don't want to defeat the purpose of our tax-free conversions here. So as we look at this, going into this situation, and again, coming up to our income and taxes, they need 100, they're bringing in 144, and so as we look at this, $144,000 is taxable at the top tax rate of 22% on these dollars, so they'll progress up through the brackets up to 144, which means if we take $1 out of this $500,000, it's going to be taxed at least at 22%. So it's important to know that because that's going to be the basis of our discussion today. And as we said, $500,000 in pre-tax, $500,000 in after-tax accounts. So they've got $1 million here, but they really don't have $1 million yet because they don't know how much of this account is actually theirs until they pay the taxes on it. So as we said, with this couple having $144,000 of income, they are in the 22% bracket. And so we don't know where taxes are going to be later. We do have some things looking backwards that we can look to see where could those brackets get to. So 2017, the reason this year is relevant is if the tax code that we're in now expires, we would revert back to the way the brackets were in 2017, obviously adjusted for inflation, which we've done here. And so if that's the case, they would jump from a 22% top tax bracket to a 25% top tax bracket. So again, a higher tax rate. And then if taxes got significantly higher, the last time that we had that happen was in the year 1981. And that was a time where taxes were noticeably higher, especially on the top end, getting it the top 70%. But for them at $144,000, their tax rate would no longer be 22%. It would almost be double that at 43% on that top dollar. So if taxes got this bad, RMDs start coming out, they're basically paying double the taxes if this is the scenario than they would be if they started taking money out now. And so as we look at it, one of the things that we always talk about when we have this discussion is really the fundamental question of, is this the right move? Is now the right time? And so we want to look at this because the one thing that matters in this discussion, and again, all the different ways that you can slice it, this is what matters truly when we're talking about Roth conversions, is when can we have the best tax situation with this money. So what we're going to look at is round number situation. We got $100,000 that stays in a 401k versus if we take that 100, move it to a Roth account, either an IRA or a 401k, and what happens when we do that. Because again, if we leave it in the 401k, nothing changes. The $100,000 stays at $100,000 for now. If we move it to a Roth, that's a taxable event, so this 100 would go, in this case, on top of 144, which would be pretty expensive, but not as bad as it could be based on where tax rates are today. So if we just looked at this and said, effective rate of 20% gets pulled off the top, and we withhold that from the account, that means we've got $80,000 to start the Roth with versus the 401k. Now most advisors will step in and they'll say, well, wait. This is why a Roth conversion doesn't make sense for my client, because they have less money. Less money means this money will grow slower, which is true. Market goes up 10%, this side's making 10, this side's making 8. But we're not looking at equivalent buckets because this one is still growing taxable, no taxes paid. This one is growing tax-free, all its taxes paid. So we've got to make these buckets come together and be a comparable situation in the future. And so the way that we do that is, let's assume that they're invested the same for the same length of time, and these accounts double in value to where we've got $200,000 in the 401k, we've got $160,000 in the Roth account. And so what we know about the Roth, as long as it's been open for longer than 5 years, all of our distributions will be tax-free on this, growth and conversion. The 401k has yet to have taxes paid, so we don't know yet. Now what's interesting is if the taxes were the same at the end that they were at the beginning, you will notice that both of the bottom lines here are exactly the same. So what matters in this discussion with the whole thing with Roth is when can we pay the lowest percentage. That is the only thing that matters in this discussion, is when can I pay. If I can do it now, it makes sense to convert. If I can do it later, it does not make sense. Okay? And again, where we start to challenge conventional wisdom, most people believe that if you have a lower income in retirement, you will have a lower tax percentage. The problem is that is not a guarantee. No one has ever promised you because you have a lower income, you will pay a lower percentage of that income to the government. It's just an assumption that we have all made. Because of the large amount of overspending that is happening in Washington, thus resulting in, over many years, a large amount of debt, now topping over $30 trillion, very high chance that taxes are going to have to go up to fix both of these problems. And if that happens, taxes are going to have to go up. But if for some reason your taxes did go down, that age-old conventional wisdom is actually correct for you, because 10% here would yield $180,000 versus $160,000, even though this bucket was growing tax-free. But like we said, if those taxes go up, if we continue to overspend, taxes are going to have to increase to cover that. And if that happens, you won't have, in very high percentage of cases, a lower income than you have today, especially if those dollars stayed the same. You would have less money staying in your pocket, more that would be coming out for taxes if that tax percentage increased. So again, what we've got to look at is, if now is the right time to start doing this, what are the rates that we need to pay attention to, but also how much do we have to look at? So again, going back to our discussion, this couple having a high income in perpetuity, because even if one spouse passes, the higher Social Security check will stay, the smaller will drop off, but they're still going to be over $100,000 of income forever. And as a single person, you're going to have more tax pressure with $100,000 than you would a married couple. So today, if they started converting, their minimum tax percentage would be 22%. If they did nothing, taxes reverted back to 2017, their minimum tax on these dollars would be 25%. And then if things got bad, like they were in 1981, 43% is where they could be looking at. But I think reality is probably somewhere between these two percentages. And again, both of those are higher than 22%, which is what they could take advantage of today. And so that's where, in this particular situation, it does make sense to convert. Then the question becomes, how much makes sense? Well, again, the lowest percentage we saw on the other page was 25%. So if they fully maximize the 22% bracket that they were in now, $68,150, and then they added another $161 on top of that, they would have $230,000 that would get converted. The effective tax rate of conversion would be 23.4%, which again is less than 25, but don't stop the video now. Because this couple is over the age of 65, we have to add in a very important metric to this discussion, and that is the impact that these conversions have on Medicare costs. And so again, what happens with Medicare, your Part B is calculated based on the amount of taxable income that you have 2 years prior to that. And so even if we do this conversion, it won't catch up with them this next year, but it will catch up with them the following year. And so anytime we go above, as we see here, $182,000 of taxable income, we start to increase the impact of Medicare Part B that gets automatically taken from your Social Security check. And so obviously this is for a married couple, so this is two people's increases. But if we start jumping up here, we have an increase. And this increase doesn't mean we don't do conversions, it just means we have to add that into the situation that we're looking at. So for this couple, if we pushed them above $340,000 of income, they would have about $6,500 of additional Medicare costs 2 years from now that you would basically just wrap back around and add on top of this 23.4% as their effective rate. But that we have to pay attention to. We can't just do conversions and not think twice about it, because our Medicare costs are going to catch up to us on the back end. So we've got to make sure, and again, this is why we say don't just look at this video and make decisions. we've got to make sure that we're evaluating all of the costs, all of the things that factor into some of these conversions. And once you get really within 2 years of Medicare starting at your age 63, you've got to start paying attention to the impact that your conversions can have on the dollars that you have later, and really the income that you have later, because it's going to be automatically pulled out of your Social Security check. So as we look at this, again, if you're looking at these type of discussions saying, man, I can't believe somebody's going in this detail, it is possible. There just aren't many people that are talking about proactive tax planning today. And so if you've not been able to have this discussion, we would love the chance to help you in this way and see if we can add value to you. See if we can help you make good decisions. And like we said, Roth conversions are not a have to. But what we do want to look at is see if now is the right time, how much makes sense, and puts you in a better position with the dollars that you've saved for retirement. So click the link below, schedule a time where we can talk. We would love to share this with you. Also, make sure that you like, subscribe, share this video with other people so that we can continue to spread this message and maybe help people legally take advantage of the tax situations that we're looking at today. So hopefully you enjoyed this content. We look forward to sharing more with you in the future, but that's all we have for today.